Hello everyone. A lot has happened since the last time we met. Inflation is at an all-time high. USA has seen the highest inflation in almost 40 years. Major agencies across the world have reduced growth forecasts, and this has ignited a debate about the possibility of a global recession. Stock markets, crypto markets, they're all loomed with uncertainty. There have been massive layoffs announced by big tech companies such as Amazon, Meta, Twitter. I'm sure you all are aware of these things. Apart from technology giants, big Wall Street firms like Citigroup and Goldman Sachs have also slashed jobs, and Morgan Stanley is also planning to cut jobs in the coming months. All in all, sad news all around. On this video, we are going to talk about, are we entering into a recessionary phase and how can it affect Indian economy? A quick introduction about myself. I'm Ayushi Chand. I have worked with the Government of India for the past 7 years as an Indian Economic Service Officer and have also served at various public policy roles. I'm here on YouTube to discuss various important issues with you regarding economics, finance, and public policy. So stay tuned, do watch my previous videos if you haven't watched them already, and please subscribe to the channel. Let's discuss what recession really is. Technically, when an economy witnesses a contraction or a fall in its gross domestic product or GDP for 2 successive quarters in a year, it is called a recession. Let us break down what is actually happening in the world and in the Indian economy. This analysis is going to help you understand whether we are actually moving towards a recession. First, let's talk about inflation. Inflation, as we know, is price rise. The current inflation rate, which affects the consumers, is called the Consumer Price Index, and it is currently hovering around 7 to 7.5%. The official figures are released by the Ministry of Statistics and Program Implementation, also called as MOSPI, periodically. So if you haven't already watched my video where I discuss the meaning, causes, impact of inflation, then please do watch it now. I have linked it on the top. The wholesale price inflation, also called the WPI, has also been on a continuous upward trajectory, rising to its highest since 1991. But why is all this happening? The first reason is the supply chain disruptions caused by Russia-Ukraine crisis. This caused a major rise in the prices of crude oil and other major commodities. Similarly, the Consumer Price Index or the CPI rose higher on account of rising prices of food items like oils and fats, vegetable, protein-rich items such as meat and fish. Apart from the global shocks, another reason for high inflation is the easy money that was flowing in the economy. Let us understand this in much more detail. To revive the economy from the negative effects of the pandemic and the lockdowns, the governments and the central banks across the world were doling out excess money in the form of cheaper loans, tax incentives, subsidy schemes, and so on. This meant that the individuals and companies, they had easy access to money at a very low interest rate. And when you have excess money in your hands, what happens? You start to demand more. This specifically is called as monetary inflation. Now, RBI has a special committee called as Monetary Policy Committee, which targets inflation. In its recent meeting, the MPC concluded that it has not been able to keep inflation between the band of 2 to 6% for the last 3 consecutive quarters. All in all, inflation has been a big cause of worry. Now, to tackle this, the RBI and the government have been taking several measures. Let's discuss these measures in detail. Interest rate hike or tightening of monetary policy. That is, the RBI has been increasing the interest rate, also called the repo rate, and that is why you have been seeing an increase in the interest rates that banks have been providing, such as those on fixed deposits as well as home loans. This has further 2 effects. The higher rate in fixed deposits and bonds gives a lucrative option for investors to park their money in. However, individuals and companies find it difficult to borrow and take loans, as most would be unwilling to pay the higher interest rate. This means that since companies are not able to borrow as much as they would like, they would not be able to expand, and therefore their profitability might be affected. This gives rise to uncertainty in the market, and the market sentiments take a hit and the equity market sees a fall. Money starts moving from equity to bonds. Investors or the FPI, they start pulling out their money and start shifting to more stable and developed economies. No borrowing by companies means less investment, less profits, and this translates into lower growth for the economy as a whole. How do the government and the central banks react now? Whenever there is inflation due to whatever factors, there is a conundrum in the minds of the government and the central bank of any economy. They have two options. Either let the inflation persist, which can ultimately hurt the consumers and lead to a fall in demand and the GDP of the economy, or increase the interest rate to contain that inflation, which can affect the profitability of the companies and affect the market sentiment of the investors. This is a debate between growth and containing inflation, which all central banks across the world deal with. This is exactly what is happening right now. Interest rates are being increased across the world economies to tackle inflation, but this is going to have a negative effect on the economic growth of these companies. Now, the big question is, does India need to worry? Well, to sound a bit philosophical, let me quote Keynes, who's the father of macroeconomics here, and say that in the long run, we all are dead. So why are we going to worry if you're going to die anyway? But let's move past the philosophical debate. Globally, rising interest rates are expected to slow down the GDP growth in the coming quarters. In the US, for example, the Federal Reserve's tightening cycle is an indication of an economic slowdown. In India, however, higher interest rates may not lead to a situation that dismal, and the hike in interest rates could play a less significant role in hurting domestic demand and the economic growth. USA is highly dependent on credit. That is, people take a lot of loan there. People and companies take a lot of loan there. The domestic credit there is about 216% of the US GDP. And compared to that, India's is only about 55%. And hence, the rising interest rates should impact the US economy more than India's. In India, there might be some impact on highly interest rate sensitive segments, but overall, on the economy, the impact should be relatively low. Second, though interest rates are rising in India, they are still below the pre-pandemic levels for several instruments. Even after the series of 2022-23 rate hikes, a repo rate at 5.9% currently is still lower than the previous peak of 6.5% seen in 2018. In contrast, in US, it is seeing much larger hikes. S&P Global expects the Fed funds rate to rise to 3% in 2020-23, higher than the level of 1.5 to 1.75% in 2020, and the highest since early 2008. Finally, another aspect that differentiates India from the US is that while the interest rates are on the rise, supply of credit so far has not been constrained. Bank credit growth is rising, driven by improving demand, which could be perceived as a positive sign for the economy. Having said that, India is not immune to the US or global recession. Though its economy was never fully coupled with the global economy, it can get affected. America's share in India's merchandise exports has increased to 18.1% in 2022 from 10.1% in 2011. This means that India is exporting much more to US now, and this increases India's vulnerability to a recession in the US economy. The Federal Reserve's rate hikes have already started impacting the FPI flows, forex reserves, and the value of the Indian rupee. So the RBI has a very tough job in its hand. It has to reconcile two goals: to restore price stability and contain inflation, and to ensure growth of the economy. So what is the conclusion from all this? Some people say that economic recessions are short-term events and economies move in cycles. So a recession would be followed by a revival. So why worry? Unfortunately, any event has long-term repercussions. So even though economic recessions are often portrayed as short-term events, the consequences of falling incomes, high unemployment, reduced economic activity can have lasting impact to the whole nation and for its individuals. It can actually push millions and millions into poverty. The conclusion is that the fear of an economic recession is real. Indicators which measure the consumer demand, industrial production, even market sentiments, they are pointing towards a looming recession for the whole world and for India as well. However, certain macroeconomic fundamentals specific to India, such as low dependence on credit, may act as a safeguard for the Indian economy and prevent it from a sure short recession. Let me put a disclaimer here. Predicting a recession has always been a difficult task. There are a variety of factors which may or may not lead to a recession. How the Indian economy or the world economy may turn out in the coming quarters is something we all will have to wait and watch. I have made a video on Can We Predict Recession? Do go and watch it after this video. With this, I conclude today's video. I hope you learned about what the world is entering into. I hope you did learn about certain economic concepts which are fundamental to today's existence for all of us get affected by it. If you have certain topics in mind, do comment them in the comment box down below and I will definitely make a video on those topics. See you the next time. Till then, take care. Bye.